Hello and welcome to the Abundance Mindset Podcast. If you read the title description, you realize this is a little bit different. And if you're listening to this, you probably work at Meta, or you are interested in working at Meta and want to know what the compensation and benefits are like, in which case you are also in the right place.
Yep, this is a targeted episode because normally we're just taking topics piece by piece, but this one is for employees who work at Meta, and they know that they can be a little bit more efficient, and they know they have rich benefits available, whether it's a 401k at Fidelity or their equity comp at Schwab or their benefits package. And so we're just gonna talk through a few of these vehicles. And themes we see within our client base that can really help people level up and start to ask the right questions.
Right. And, the thing about financial planning is it's different for everybody. Everyone has different goals, different circumstances. Everyone at Meta is not paid the same and compensated the same, right? However, there are themes that are the same when you work at the same employer, right? You've got the same 401k available to you. You've got the same general structure for your equity compensation. You've got the same benefits. So there are sort of grooves of expertise, right, that have built over time. And if you're working at Meta, your plan won't look just like your coworkers, but your plan is going to have similarities because you share the same employer. And of course, that goes for any company you might work at. But Meta in particular is a really interesting one to look at right now, in part because of its growth, the changes in its stock over time, the way it leans on equity compensation for key employees. So there's a lot of planning and tax efficiencies that are going to be heightened and multiplied for people who've been working on Meta over the last several years.
Right, exactly. So let's just start with the 401k, right? Big bucket, big lever when you're talking about investing, retirement, and tax strategy. And so when we think about the 401k, we, especially at Meta, we think about it in layers. And the first layer would be just how you're contributing to it, which sounds simple, but no, not really, because especially for people who are hitting that inflection point where they're making more money or they have more RSUs vesting or they're, getting bigger bonuses, they hit this inflection point in income when they contribute to the 401k. Meta is one of the 401ks that actually lets you contribute your bonus within that Fidelity portal. You can elect to have your bonus be contributed or just your base salary. And so depending on however which way you're contributing, just the sheer amount, a lot of people, especially when they get bigger bonuses or increased income, are actually maxing out the traditional 401k too fast, right? And what I mean by that is they are hitting the first IRS limit, that 23,500, earlier throughout the year, right? So let's say they've maxed out the first part of their 401k in July. And ultimately what that does is then it keeps people, employees, from being able to buy the market then
Mhm.
let's just say second half of the year, whenever that first max is hit, depending how you have yours set up. And so let's say the market, like it did last year, dropped in the fall, right? It went down. And unfortunately, I've already maxed out my 401k. And so I wasn't able to buy at that down market. I
Mhm.
wasn't able to purchase the market when it went down or dollar cost average the best price with my contribution. So that's just the first baseline layer, right? How are you contributing? How much? And you have it spread out throughout the year to really maximize, buying the market at different times.
Right. And Meta has a tool available to it that in its 401k that most 401ks we've seen don't have, which is the ability to parcel out your percentage contribution from your regular salary and your percentage contribution from your bonus. A lot of times we'll have people, if their savings rate supports it, contribute 0% from their bonus because your bonus is variable, but your salary, at the beginning of the year. And so you can be much more precise about your contributions via your salary. Doesn't mean it's necessarily right or wrong for you, but the ability to move either of those up or down is unique and beneficial within the Meta 401k.
Right. So the next layer is the tax wrapper, right? Your contributions going in, how are they taxed? So Meta has pre-tax and Roth for the initial 23,500, right? That's the 2025 IRS limit for that standard limit, and you can contribute in pre-tax or Roth, right? So it can be tax now or tax later, at ordinary income rates. And that's the first decision too in planning and what lever you might pull. Are you looking for, a larger deduction this year and your financial planner is wanting to utilize pre-tax for, a strategic reason there? Or are they saying, hey, we should do Roth because we're looking at your overall tax drag and it makes sense to, soak up this current income bracket and, have tax-free wealth growing. So or is there a combination, right? Depending on what tax bracket you're in and how much wiggle room you have to soak up. And so that's kind of that first lever within the plan up to that 23,500 limit.
Yep. And above that limit, Meta does have the after tax option with what some people colloquially call the mega backdoor option. So, what that means is a combination of after tax contributions, meaning you can contribute in an after tax manner above that 23,500 limit, all the way up into 70,000 in 2025. Combination of the regular limit, your employer's match, and after tax contributions can't exceed that amount. So it's a combination of that with an in plan Roth conversion feature, specifically for Meta, an immediate in plan Roth conversion, which means that daily they will contribute any amount that's put into after tax. They will convert it to Roth before it's had a chance to grow and change. So I know that's a lot of words, but it's a really important feature.
Well, and yeah, that feature you have to elect, right? It's something that you have to click, and so on the Fidelity portal, and this is where when we get above that 23,500, if we're going for that IRS limit of in 2025 70,000, which is a mix of that first 23,500 and then the employer match, and then whatever the number is, you can meet to make and hit that 70,000 in that after tax bucket. A lot of mistakes are made, and 9 times out of 10, I just don't see a lot of reason for money to sit in after tax, right? To go through the back door, but not actually make it through and just sit in after tax. And so if you're not using the feature that immediately converts those dollars from after tax to Roth the day of contribution, I just see a lot of mistakes here. And so when you're using the mega backdoor as colloquially referred to, make sure you're using it right from a tax perspective. A lot of mistakes here, a lot of cleanup here. And so this is the part of the 401k that there's probably a deeper conversation of from a tax perspective, but different levers you can pull, different limits you can soak up, and ultimately depending on what moves you're making each year from a tax perspective, you might change how you're adding and using those features.
The next piece on optimizing the Meta 401k is, or the next layer that we talk about is the investment selection. So, what are you actually putting your money into? Like pretty much any 401k, Meta is going to have a range of investment selections. You're going to have the cookie cutter target date funds. So, these are the funds that you put money in. They've got a target date, right? It's the date that approximates when you think you want to retire or when you expect to retire. And they invest the money for you and year over year rebalance and move you more and more conservative over time. So Meta has those options. And then they also have a number of equity index funds. So some are cheaper than the target date funds. Some are, historically speaking, with a higher return. But a lot of times people aren't aware of what options they have available in their 401k for investments or don't have a strategy for putting together those investments.
Right. And even beyond the kind of the cookie cutter Vanguard target date funds and then the indices available, there's even a brokerage link which opens up a whole other slew of
Right.
options. And people a lot of times people just get a little scared, especially when they see like the do it yourself option. But you know, uh, this is where it really matters when we're looking at 20 plus years of possible growth, right? So as long as you've got your contribution layer fixed, your tax layer, how you're adding pre-tax, Roth, after tax, if you have those set, that's great. But then it's this investment layer where, you want to be very precise and very
Mhm.
active and proactive because it can be compounding interest, like the multiplier effect is huge. And so, and you want these investments working with your outside of 401k investments, right? And so it's just making these things work together efficiently, talk to each other. And people just aren't aware of the fees that they're paying inside of here. They aren't aware of whether it's diversified or rebalancing. You want to make sure that you're aware you can put together your own portfolio. You can have it be rebalanced, and you just want to maximize gains. Because if you're just in a Vanguard target date and you don't want to be, because they're just buying more cash and bonds as they get closer to the target date, and maybe you're in your 30s and 40s and you don't plan on retiring in the next 5 to 10 years. So we don't want to hold cash and bonds and have that drag on our portfolio. So maybe you want to look at some of these other options, which there are inside of the plan. Depending on how wide you want to spread that net, there's different features, whether it's brokerage link or the other indice funds. But it is something that you can get precise with, and just an area where you can level up. And ultimately, the last thing I'll say there is just being aware of rebalancing and having these same funds when you click your current and future investments. So these are all buttons you're going to see within the Fidelity portal, but this is just an area where people can get really precise, really efficient, especially with such a large bucket, especially if you're using the mega backdoor, right? This is a decent size of your overall retirement savings.
Right. And so you do want to be precise there. You don't want to be willy-nilly. You don't want to miss out on fractions of percentage points of possible return, because that really multiplies and compounds over time when you're looking at a 10, 20, 30 plus year time horizon before you're touching those funds or using them. So Meta allows for you to do a lot with your 401k, but with great power comes great responsibility.
Yeah. I mean, there's even ways to have a certain part of the portfolio elected that's invested a certain way. And so you can get really precise, especially if you're getting close to retirement. So,
Yep.
really great tool.
Yeah. Maybe the last thing I just mentioned about the 401k, because if you don't know this, you certainly should know this if you work at Meta, but Meta has a discretionary match. Most employers simply name their matching formula, but Meta doesn't, which means they can choose how they're matching. What we've seen in recent years is a 100% match up to half of the IRS maximum. So that is a lot larger, a lot higher than most companies. And so, yeah, if you're working at Meta and you aren't contributing at least half of the IRS maximum, so 11,750 in this calendar year, 2025, you're missing out big. And if you don't plan on working at Meta forever, know that like future 401ks probably aren't going to give you as generous of a matching provision. So that's just a lot of money that's going into your pocket in pre-tax, notably, back to our tax wrapper conversation. But it's money going into your pocket that Meta is matching.
Yeah. And I mean, even going back a little bit further, depending on working with your CPA and financial planner, they might want to look at converting that match in pre-tax to Roth over time. So there's just all these layers and features and levers that work together, but really fun tool to, just generally do a sweep on for how you can maximize it for your personal plan.
Yep, 100%. Okay, let's move on from the 401k to another piece that is, there's some unique planning aspects to Meta when it comes to their stock. So a lot of companies give equity compensation, especially technology companies, especially high growth companies or startup companies, which, of course, Meta is not a startup at this point by any means, but they give standardly restricted stock units to employees. Again, this is at the discretion of the employer. Not everybody is going to get these necessarily, but it's a common way for them to say, okay, we've compensated you with your salary. Now we're going to compensate you with stock.
Right. And once you start receiving RSUs, that tends to be an inflection point for people where they just know they need some planning. But if they know they do, but sometimes it just sits there. Because they don't know what to do, employees will sit there with so much stock, so much Meta stock, and then all of these Meta RSUs being granted to their Charles Schwab portfolio, or not portfolio, but platform. And, you just don't want to fall into analysis by paralysis. So let's just break down how it works. Again, can't give you advice, but it really keeps some people up at night.
Yeah, and I think what's particular, this is both a challenge and an opportunity for Meta, but the volatility of the stock. Currently, at the stock price right now, it's quite high as of the recording of this relative to where it's been, which
Mhm.
is great news. It's an opportunity. But the way that, just to back up, the way that RSUs tend to work is your employer is typically going to set like a dollar value target and say, Allison, we want to grant you for this calendar year about $100,000 worth of RSUs. Meta has them typically, at least what we've seen, vest quarterly for 4 years. So we're going to say, okay, how many shares of Meta fit into 100,000? That's what we're going to grant you for this bonus season, in March, with your compensation changes. So then starting in June of this year, that stock's going to start vesting. But I think the important point is that they're creating that number of shares to grant based on the market price of Meta. And if you've been at Meta for the last several years, and if you've paid attention at all to the market price, you know that it has fluctuated dramatically. So I'm going to read 2021 through 2024 share grants for a client that we worked with, and just note how wildly these have differed. So 949 in 2021, 249 in 2022, 897 in 2023, and 268 in 2024. This person wasn't a better or worse employee in these years. It was just that Meta stock was changing dramatically. And so now here in 2025, those grants of almost 1,000 shares, split across quarters, are vesting regularly, but it's way more shares per quarter in those grant years than what they were granted when the stock price was higher in 2022 and 2024. So what I'm getting at here is if you've worked at Meta in the early 2020s and you were getting RSUs, chances are you got a lot of stock grants that are now multiplied by current stock value and are worth a lot more than Meta had initially anticipated when they gave you that stock. So you're getting a sweet deal out of it. All that to say, though, that creates a really large concentration planning issue, and it also creates a really large tax planning issue for you. It's great to be getting a lot of money, but are you planning for concentration, and are you planning for tax as those RSUs vest effectively?
Right, exactly. And that's where, the emotion of this comes up because they see these dollar signs, these big dollar signs, and which also can mean big tax dollar signs sometimes. But 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 people are being kept up at night because they don't want to hinge their goals or their retirement on Meta stock. Right.
Mhm.
And so that's this concentration risk, right? And so they don't have a strategy for peeling it off and diversifying, right? And then from a tax perspective too, yes, there's so much strategy in how you peel off equity comp, specifically RSUs and when, right?
Mhm.
Is it at vest date, right? Like on that date? Or are you going to wait a year after vest date until it's long term? It's a long term lot versus a short term. So these are the questions you have to start to ask with your financial planner.
Right. And in terms of in-year tax withholding, you also have to realize, particularly when you have a stock like Meta, that's price is moving dramatically, your tax bill for the year and the appropriate withholdings that you should set are going to be in some ways dependent on Meta stock price at the date that it's vesting throughout the year, the multiple dates that it's vesting throughout the year. So even if you're doing tax projections with your CPA, you need to revisit those those toward the end of the year. Especially Meta did have a recent run up, right? So your August and November vests could be dumping more income in your lap than you realized. And again, hashtag good problems, but bad
Mm.
problems if you're managing your tax liability incorrectly and exposing yourself to things like under withholding penalties.
Yes, if you're not being proactive with this, proactive with your withholdings, if you're not doing it yourself, you need to pay someone to do it. And I will give you that advice because this is one of those areas where you can't just sit and let it happen.
Yeah.
You want to keep your money, right?
Yeah. Lastly, if you're getting RSUs and you maybe haven't paid much attention to them, it's on a separate portal from your 401k, like log into that portal and check your beneficiary because it happens so frequently with people's stock grants that don't pay attention to them that they just never logged into the portal, never set a beneficiary, and they just have hundreds of thousands that would not go to their spouse without probate,
Right.
which
Yeah.
is a tragedy.
Get into Schwab and make sure you have the appropriate labeling on the account because so many people don't. And yeah, you don't want to tip the government. You don't want a percentage to go to probate just to figure out where it should go.
Yeah, 100%. Okay, let's move on to last topic. So Meta's benefits outside of 401k, outside of equity
Mm.
compensation. Just a few big hitter items that you should be aware of, just options you have available within Meta's benefits package.
Yeah, and there's so many. So this is where, we'd really have to know you and your goals and even your health and your family. maybe there's some things you can waive because, oh, you really don't need this, but there's also some that you should press in. And at least one theme that, generally speaking, if you're talking to any CFP, they're going to say, oh, make sure your clients are maximizing their long-term disability, right? Long-term disability. So we're talking, illnesses that can keep you from working, and or sorry, not Facebook. Meta offers
Yeah, Allison's been around long enough that it
yeah.
used to be Facebook.
Yeah,
So
right. Yeah, I saw that
yeah,
stock
we're used
stock
to
drop
Meta,
years ago.
Meta, Meta.
Right, exactly. So, okay, so at Meta, they give you 2/3 long-term disability. So 2/3 of your salary is
Mhm.
covered. But here's the little, piece of advice and theme that I've noticed is a lot of people aren't paying for it. And it's not expensive, but here's the difference. The benefit, that 2/3 of your salary, if Meta's paying for it for you, which, yeah, you might think is nice, if you actually experience a long-term disability claim, then that 2/3 of your salary that they were paying for the benefit and the income to you is taxed. And so if I am working at Meta, I am paying the couple bucks for my, it's not a quote, but the cheap benefit of long-term disability and relative to my salary. I am paying for that benefit, which Meta allows you to do, but you have to elect. So, we're getting this podcast out, probably before even enrollment here. So look to pay for your long-term disability.
Mhm.
See what that option is, because then if I'm paying as the employee for this long-term disability benefit and I experience, I can't work for 4 years because I got, an illness that's keeping me from being able to do my job as easily, then I'm getting my 2/3 salary tax free. I'm actually getting 2/3 of my salary. Not, 45% depending on my tax bracket.
Yep. Yeah, so very small decision that can have huge ramifications, positive or negative for you. And even just to back up and you're being a good CFP, when we're talking about disability, the reason, right, that any good CFP is going to tell you to maximize that is, we don't think about this, but like statistically, you are much more likely to experience a long-term disability event than you are to die early. And that's why disability insurance is typically more difficult to obtain, and why
Mhm.
maximizing what you just get without having to prove insurability through your employer can be really beneficial.
Yeah, people in general, and females more so than males statistically, according to the Social Security Administration of Stats. And so, yes, there's a lot of reason to do this. I mean, if I'm a high income earner at Meta, I'm not just paying for my disability insurance at Meta. I'm probably even supplementing outside to get as close to, 95% as I can of my salary. But ultimately, just we're talking about Meta maximizing benefits. That's one way and one thing I double click on.
Yep. Yeah, another one that's important, and can't give specific advice here. This is so personal to people, but it's health
Yeah.
insurance. So
Yeah.
Meta has a pretty rich health benefit package, and particularly, health savings accounts, super tax advantaged account, a deduction on the way in, growth that is tax free, and tax free withdrawals provided it's used for medical expenses. To have an HSA, you need to elect a high deductible health plan. You may know that, you may not. Meta's high deductible health plan is about as low of a deductible, meaning you get about as rich of coverage as the IRS allows while still maintaining the high deductible health plan qualification. So, as of this calendar year, 2025, their deductible was 1750, which is just above the IRS minimum. So there could be reasons that you would want the copay plan. We're not trying to stomp on those reasons. If you're generally healthy, you generally have a risk tolerance. For a family, you can contribute 85.50 to a health savings account in 2025, roughly half that. If you're a single, having the high deductible health plan with pretty rich coverage gives you access to that vehicle, and it's about the best coverage you could possibly have while still being able to contribute to an HSA. So
Right.
this is something that I would just strongly consider, short of telling you should just do it, but strongly consider if you're at Meta.
Yeah, if you like a triple tax advantaged deduction as well as being able to invest your HSA, make sure to take a look at the plans.
Yep. And if you elect the HSA this upcoming open enrollment season, make sure that it is the HSA, because there's a few acronyms. There's HSA, there's FSA, and Also, something we've actually seen people trip up on a lot recently has been the DCFSA,
Mm.
Dependent Care Flexible Spending Account. We've had um, a couple contribute collectively over the IRS maximum accidentally between the two employers. We had someone elect it who doesn't have any dependents, right? Like it has a purpose. It's for a tax efficient way to pay for dependent care. But if you don't have a dependent, don't elect that.
Right, and if you're over contributing, and it's not being caught, then it's coming back to you as taxable income, and you can get a penalty or a tax, and so it's just you wanna make sure you're using the right vehicle, and then you're using it within its limits, but generally speaking, we really like the HSA.
Yep. Yep. So yeah, even within, benefits, disability, health, there's tax advantages, there's efficiencies that overlap heavily with financial planning, right? Like as a part of financial planning, we're reviewing benefits. That's why we're familiar with Meta's benefits because maximizing the efficiency of every piece of your financial life is really what comprehensive financial planning is. So yeah, this has been a snapshot of Meta in 2025, some of the really powerful levers that are available to you as an employee of Meta, and yeah, some frameworks of how we've helped people maximize those.
Yeah, and if you're working at Meta and "Oh, I wanna be able to maximize my benefits," you do have these unique levers, and so it's even more an encouragement to you can use these unique levers within your financial plan, and you might even have some advantages over other people who aren't working there, and so use this time that you are working at Meta to maximize those benefits within your plan, and within your plan because it could be tax levers within your 401k or RSU strategy or being really strategic with those levers to control your overall tax drag to maximize, your tax landscape and soaking up favorable brackets and being strategic with even your investments and investments outside of Meta. And
Mhm.
so there's just all of this planning that works together and it either can work for you or against you. And
Mhm.
so just be intentional about working working what you have in front of you within your overall financial plan so that you can maximize the time that you're here. And so, yeah, and if you're listening to this and you know that you can be more efficient or you're kind of done DIYing it or you think your financial planner isn't, maybe at this level and they could do a little bit more, if you're hitting that inflection point, then you should reach out because there is such thing as a niche, in this space and just being a high income earner and wanting to make the most of your wealth and stewarding it well and being wise and thoughtful. These people care, these are smart people and they just want to make sure that they can keep their money and they can steward it towards their future and be as flexible as possible and as efficient as possible. So if that's you, and these things are hitting you and they're relevant and they're just a part of where you're at today, then yeah, go on our website and contact us and set up a consult because we offer 60 minutes for free just to talk about this
Yeah.
to see if it's you because this is so general. Because yes, we have these common platforms in net benefits and Fidelity and Schwab and other platforms, but it's how do we actually make sure it's working and spinning around your goals personally.
Yeah, and even just to underscore, something you're saying, there's such a thing as niches within the financial planning industry. I think kind of with any industry, when you're outside of it, you're like, oh yeah, like everyone just kind of does the thing. But financial planning, as with any industry, like there's specialties, and we've had the opportunity and ability to, yeah, build strategies, build systems, build tax aware Excels that run in the background that are specifically aimed at helping people in these situations. So this is an area we're passionate about and an area we're skilled in, which is why we wanted to kind of put some of the information out here in the first place.
Yes, exactly. So, I'm glad you stuck through this episode, and if you are just looking to level up and you think that there's more, then go ahead and reach out and book a consult, and we will talk about how this can apply to you specifically versus just these overall meta themes. Meta themes.